Mortgage interest rates in the US have been rising in 2024. Also government bond rates and corporate bond rates, which is probably the opposite of what you thought was going to happen.
High anticipation that there were going to be lots of rate cuts. That seems to be less the case now.
The committee decided at today's meeting to maintain the target range for the federal funds rate.
This is Jerome Powell. He's the man who decides every month whether the interest rate on your home loan goes up or down. Well, not exactly, but what the Federal Reserve decides does influence home loans and bond rates. But they're not directly in control. So what's driving interest rates up in 2024? Why are they rising when the Federal Reserve is promising interest rate cuts? And also a look at why some of the latest economic data is misleading you about what's really going on. Just before I get to all of that, I just want to pause the video very quickly and talk about the sponsor of today's video, private internet access. Browsing the internet with an unencrypted connection is like walking around with your brokerage statements printed on your shirt. Everyone can see how much you lost on AMC stock when you should have just been buying the index. Don't buy meme stocks, but more importantly, use a VPN. A VPN is an app that hides your IP address and safeguards your internet connection through an encrypted tunnel. When you browse the internet without a VPN, your device is transmitting huge amounts of private data that can be intercepted by hackers. They can grab keystrokes and photos, and even your passwords are vulnerable, meaning your bank accounts and social media logins. A private internet access VPN allows you to change your IP address to one of 91 countries and all 50 US states. So you can overcome location-based restrictions such as accessing the full library of streaming services like Netflix. Recently, I've been watching Better Call Saul again by using my PIA VPN and connecting to an American server. Regardless of the operating system or the device type, from your phone to your living room, you can protect unlimited devices with just one account. Private internet access is giving my audience a huge 83% discount, so you can subscribe for just $2.03 per month and get 4 extra months for free. Go to piavpn.com/Hamish. The link is also in the description below. By far the biggest factor that influences the rate you pay on your home or business loan is the Fed. The Federal Reserve is the central bank of the United States. The system is composed of 12 regional Federal Reserve banks and a body called the FOMC. The FOMC, or the Federal Open Market Committee, has 12 members. 7 members of the Board of Governors led by Chair Jerome Powell, the President of the New York Fed, and an annual rotation of 4 regional Fed presidents. The Fed has 2 main goals that they call the dual mandate.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
Get as many people employed as possible while maintaining price increases to around 2% per year. They use a basket of tools called monetary policy to achieve these goals. The one you've probably heard of is manipulating interest rates. And they do this through their relationship with US banks. Commercial banks are required to have a special bank account at the Federal Reserve. In it, they keep cash reserves that can be used to cover their withdrawals. The money that the bank keeps in this account is also earning interest, just like any other savings account. And the rate of interest that they earn is called the federal funds interest rate, a rate that is decided by the voting members of the FOMC when they meet on 8 separate occasions throughout the year. Cash in these Fed bank accounts is also lent out to other banks at the same rate. So by controlling this key interest rate, the Federal Reserve can control the amount of money held by the public, which is called the money supply. They can slow consumer and business spending and therefore the economy by raising the federal funds rate, cooling the economy when prices are rising too fast, and on the other side, heating the economy when unemployment is too high. Today, the economy is actually in pretty good shape. The Personal Consumption Expenditure Index, which is the Fed's preferred measure of prices, was 2.5% in the year to February 2024. The Consumer Price Index, another measure of inflation, is at 3.2%, both slightly higher than the 2% target. The labor market is full steam ahead, with unemployment reading just 3.9% in February, and real GDP growth as of the 4th quarter of 2023 showed the country grew its economic output by an impressive 3.1% in the last year. Prices have gone up a lot since COVID, so this isn't to discount the very real cost of living crisis that many people are facing today, But what these numbers show is that there is much more price stability in today's economy than there was just a couple of years ago, or even just last year. Currently, the effective federal funds interest rate is at 5.33%, and it's been at that rate since August of 2023. At the March meeting just a few days ago, the FOMC decided to keep the rate the same.
The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. Recent indicators suggest that economic activity has been expanding at a solid pace.
But hang on a minute. If the Fed has kept their official interest rate the same for 8 straight months, how come all other interest rates are rising? Take the 1-year US government bond, for example. Its rate has risen from 4.1% to 5% this year. Longer government bond rates are also going up. The average 30-year fixed mortgage rate has risen from 6.6% to 6.9%, and even corporate bonds as well. Well, as I mentioned, the federal funds interest rate is directly set by the Fed, but all other loan rates are determined by the borrowing and lending habits of people, businesses, and the government. And they don't care about what the federal funds rate is today, they care about what it will be in the future. The easiest way to see what I mean is by taking a look at US government bonds. A 1-month bond where the government is borrowing money and paying it back in 30 days has a rate that's pretty much the same as the federal funds rate, because the bond is super short term and it's basically risk-free. So for a bank, for example, who has the choice of storing cash either in a 1-month government bond or their Fed bank account that earns the federal funds interest rate, both of those two products or places where they could put money essentially offer the same terms. So they have basically the same rate. But a 1-year government bond is different. The bank would be locking their money away for 12 months. So its interest rate reflects the expectations of where the federal funds rate will move over the next 12 months. This market dynamic is why the interest rate on a mortgage has gone up even though the Fed isn't raising interest rates anymore. The mortgage rate reflects the changes in expectations for what the Fed will do with interest rates in the future. And then eventually, as reality converges with past expectations, mortgage rates and other loans and other interest-bearing assets can see their interest rates move in a different direction to what the Fed is actually doing. Every quarter, the FOMC releases their projections for interest rates. In September of last year, the FOMC said they expected interest rates to go from 5.4% to somewhere between 4.6 and 5.4% by the end of 2024. Hardly any decline at all. But by December, their projection now said 4.4 to 4.9%. And check what happened to mortgage rates during that period. They declined from 7.8% to 6.6%. As time went on, the Fed started to project more and more rate cuts in 2024, so banks reacted by selling their mortgages at lower interest rates. So now let's have a look at what's happened since December. Each dot on the graph represents a different FOMC committee member and their projection for rates by the end of 2024. In December, most members expected 3 to 4 rate cuts, and one member even suggesting taking rates below 4%. Fast forward 3 months to March, and now only one member is saying 4 rate cuts. Almost all members think 2 or 3 cuts, and there's even 2 members now projecting no rate cuts in 2024. So even as the actual federal funds rate hasn't changed through all of this, the Fed's projections of where rates will be by the end of the year has changed. Rates are going to be a bit higher than previously thought, so naturally mortgage rates and other loans and bonds have responded with rising rates. The Fed isn't new to revising their projections. In fact, they're also just notoriously bad at making projections. And the most laughable example of this was what happened with their inflation projections in 2021 and 2022. Check this out. In March of 2021, they thought inflation would be 2.4% by the end of the year. In June, they revised this to 3.4%. In September, they revised it again to 4.2%. And in December, they again changed their projection to 5.3%. 2021 inflation measured by PCE was 6.2%. Really think about that for a moment. At the start of the year, they thought inflation would be 2.4%, and it ended up being 6.2%. But even more ridiculous is their December prediction. A prediction they released 2 weeks before the end of the year was off by almost a whole percent. In 2021, their projections were so bad, they couldn't project 2 weeks into the future. And 2022 wasn't much better. The point of all of this being that the Fed just has very little visibility, even 6 to 9 months into the future, for what these economic indicators will look like. They just make a projection at the start of the year, and then each quarter they adjust it slightly, which is a really important thing to understand. A lot of people will look at the current projections for 3 rate cuts and think that we can trust it. The reality is it's possible that we see 3 rate cuts, but it's also possible that the Fed just keeps adjusting their projections throughout the year, and by December, they're no longer planning any rate cuts at all. Whether your mortgage rate is going to go up or down throughout this year is ultimately going to be heavily dependent on inflation. And in past videos, I've spoken about some of the risks for inflation getting a lot worse. But there's also 2 very compelling arguments for why the worst of inflation may very well be behind us. The first comes from the Fed itself. Adriana Kugler is one of the 7 Fed governors, and she believes inflation will continue to ease in 2024 and for the economy to avoid a recession altogether. At Stanford's Economic Summit, she said, "I am cautiously optimistic that we will see continued progress on disinflation without significant deterioration of the labor market." Her view is that the inflation we've seen up until now has largely been driven by supply shocks, both to the availability of goods and labor. So businesses responded to higher costs with higher prices. But that in 2024, the restraints have dropped as quickly as they rose, that the supply chains for goods are free-flowing, and wage growth has slowed. But by far the most interesting disinflation argument comes from the housing sector. A viewer of the channel, Matt Bryson, who works in the finance advice industry and has been researching the markets for many years, was kind enough to share some of his insights. The Consumer Price Index, one of the main inflation measures, reflects the price changes of different goods and services. But shelter specifically makes up over 36% of the total. So how the cost of rent, for example, is measured can make a big difference in how the overall CPI figure looks. Shelter inflation is split into 2 categories. The first is rent of primary residence. It's 7.7% of the overall CPI figure, and they calculate the price of rent by looking at current rental agreements between landlords and tenants. The problem is that rental agreements are often 6 to 12 months long, so this figure is actually measuring rent prices from many months ago. A much better way to measure current rent costs would be to look at current asking rents. And if we compare the 2 measures, you'll see that the growth of the cost of rent is a lot lower than what is being reported in the CPI data. Or in other words, if the cost to rent continues to grow at a similar rate throughout the year, then it will basically put downward pressure on the overall CPI figure. The other component of shelter is called owner's equivalent rent. It's measured by sampling homeowners who live in their homes and asking them how much they could rent their home out for. This is a terrible way to collect data because it's extremely subjective, and it also seems to follow a similar trend of growth to the rent of primary residence category, which means it also probably lags the actual rental costs. If we remove shelter from the CPI data, headline inflation would be just 1.7% today. So even when assuming that rents will continue to rise in 2024, the actual inflation figure may be a lot closer to the Fed's 2% target than it currently looks, which would justify their plans to cut rates this year. Now, I know I probably titled this video something like "Rates are going up," and it is true. Rates on bonds and mortgages have been rising so far in 2024, reflecting the changes in future expectations. But I don't personally have a view of where I think interest rates will be by the end of the year, because not even the Fed knows, and they have way more data and experience than I do. But if you enjoyed observing the data with me, consider hitting the subscribe button and check out this video where I explore the inflation risks posed by the Red Sea shipping crisis.